Then in step 3, we wrap everything up and calculate the value. So first, you just start by bringing the net present value down. So by inputting all of the future cash flows into our financial calculator, we calculated the net present value at the 31st of December 2018. Then you need to add or deduct any cash balances. So any positive cash balances are added and you deduct any bank overdraft. So if you go back to the information provided in the question, you were told that included in current assets, you have cash and cash equivalents to the value of 1.86 million rand. So easy, include that in your calculation. Then you need to add the value of any non-operating assets that are valued separately. So if the company has any investments, we value those investments separately and we bring the value in over here. Now, if you go back to the information provided in the question, you'll remember that Springfield has an investment in Lannister Limited because they hold preference shares in Lannister Limited. And you'll remember we said these are non-redeemable preference shares. So using this information, we can calculate the market value of these preference shares. Because if we are trying to value a non-redeemable preference share, we perform a perpetuity calculation where we take the dividend cash flow and we divide by the cost of the preference shares. So these preference shares have a nominal value of 4 million rand and they carry a 15% dividend that is payable annually in arrears. So remember we said this 15% over here is the coupon rate which we'll use to calculate the dividend cash flow. So you take the 4 million rand, you multiply that by 15% so that you can calculate the dividend cash flow. You use the coupon rate when calculating the dividend cash flow. Then we were given the cost of the preference shares because you were told that a fair rate of return for preference shares with a similar risk profile is 15.3%. So that is the cost of the preference shares. It's the market-related rate. So you divide by 15.3%, and that will give you the market value of the investment that they have in Lannister Limited. So if we just quickly jump to the calculation. All right, I just performed this calculation with you over here. Take the nominal value, multiply by the coupon rate to calculate the dividend cash flow, divide by the cost of the preference share, and that will give you the market value of this investment. And you just add that to step 3 of your calculation. And make sure you reference to the calculation. Then we need to deduct the market value of debt. Again, go back to the information provided in the question. You don't have to calculate the market value of debt. You've been given the market value of debt. The market value of the loan at the 31st of December 2018 is 15 million rand. So, simple. Just include that in your calculation. All right, so that then gives us the fair market value of 100% equity. After we have the fair market value of 100% equity, we need to take owner level or shareholder premiums and discounts into account. So first you need to consider whether a control premium should be added to the value that you've calculated. Now guys, if you go back to the required, we are calculating the value for a 100% equity interest in Springfield. So we are definitely valuing a controlling interest. However, the value calculated over here, because we are using the free cash flow method, the value calculated already reflects control. So you can't add a control premium because then you will be double accounting for it. So please note the value calculated already reflects control. So we are valuing a controlling interest, but this value already reflects control, so we don't need to add a control premium. Obviously, we don't need to deduct a minority discount because we are valuing a controlling interest. However, you do need to consider whether a marketability discount should be deducted. And guys, you are valuing a private unlisted company. We are valuing Springfield Medical Clinic Pty Limited. So because we are valuing a private unlisted company, it will be more difficult for Healthstone to sell the shares in Springfield, so we need to deduct a marketability discount. So I've just deducted a discount of 5% and get a subtotal. Then go back to the required. We need to calculate the maximum value. So I said to you, the maximum value includes all general and also specific or unique synergy benefits and costs. So, did we have any of this information provided in the question? Go back. First, we were told, strategically, this is an ideal fit for Healthstone, and post-tax synergy benefits of 650,000 Rand per annum at current prices are expected to materialize. So we do have synergy benefits over here that we need to take into account. But please note, guys, this is not a once-off synergy benefit. It is a recurring benefit. It is a synergy benefit of 650,000 Rand per annum. So we need to perform a perpetuity calculation. All right, it's not a once-off benefit or a once-off saving. It's going to happen every year. It's per annum. So we need to perform a perpetuity calculation. So these are the post-tax savings as a result of the acquisition. Now, once again, guys, when you perform a perpetuity calculation, you are applying the principles of Gordon's dividend growth model. So that's Gordon's dividend growth model. First, you take the future expected dividend. So obviously now the terminology changes. We are not working with dividends. We are just working with post-tax savings. But we need the future estimated post-tax saving. Now, the saving that you were given in the question is the saving at current prices. So guys, you need to increase that because we don't want the current saving, we want the future expected saving. Remember, we use D1 in our calculation. It's always the future expected amount. So we don't want the saving at current prices, we want the future expected saving. So how are you going to calculate the future expected saving? Well, the only thing that makes sense is to increase that saving by the inflation rate of 5% per annum. In the absence of any other information, that's the only assumption I can make. Obviously, if they gave me a specific growth rate relating to the post-tax savings, then I'd use that growth rate. However, in this question, we are forced to use the inflation rate. All right, so let's look at the calculation. You take the current post-tax savings and you grow that by the inflation rate so that you can calculate the future expected post-tax savings. Please note that the savings here must always be post-tax. So if you're given any savings before tax, just multiply by 72% so that you can get the after-tax savings. And please note you're also always working with annual amounts over here, not monthly amounts. So two important things. This must be after tax and it must be annual. If they give you a monthly saving, you need to multiply by 12. If they give you a saving before tax, you need to multiply by 72% to get the after-tax saving. All right. Then, when using Gordon's dividend growth model, we divide by the cost of equity. So we use the cost of equity as our discount rate. However, when calculating the present value of a general and specific or unique synergy benefits and costs, you should use the company's WACC as your discount rate. So we divide by the WACC and we subtract constant growth in perpetuity. So again, I'm just assuming the inflation rate is my constant growth in perpetuity. All right, and if I include the future expected post-tax savings in my calculation, that will give me a present value today. So that is the present value today at the 31st of December 2018. Then, there was one other thing we were given here. legal and other acquisition-related costs at present value. So we have an acquisition-related cost that we need to take into account, but luckily we don't need to calculate the present value. The present value has been given to us. We have a cost of 2.5 million rand. So obviously the post-tax savings is a synergy benefit. That would be an inflow, so show that as a positive amount. And the legal and other acquisition costs will obviously be a cash outflow. And you were given the present value, so just include the present value. All right, so you can then add those together and calculate the present value of general and specific or unique synergy benefits and costs. And we need to include this in our calculation because we are calculating the maximum value. So if you go back to step 3, you just include that in your calculation over here because we are calculating the maximum value. So where do you take these synergy benefits and related costs into account? After you've looked at your owner level or your shareholder premiums and discounts, but before you multiply by the percentage shareholding, you take it into account. Now, we don't need to multiply by the percentage shareholding because in the required, we were asked to value 100% of the shares in Springfield. So that is the maximum value, and that answers part B of the required.